Hello and welcome to MediaNama. Recently, the Securities and Exchange Board of India, or SEBI, proposed a regulatory framework to enable safer participation of retail investors in algorithmic trading, better known as algo trading, through brokers. The framework was an extension of SEBI's 2012 guidelines on algo trading, which was initially accessible only to institutional investors. For context, institutional investors are companies or organizations that invest on behalf of other entities, while retail investors are individuals who invest their own money. Before delving into what the proposed new framework stipulates, let's talk about algo trading. In simpler terms, algo trading is an automated system that uses computer programs to automatically purchase and sell stocks based on certain set rules. These algorithms can be based on several inputs like price, timing, quantity, among other metrics. For instance, an algorithm might be set to buy a stock if its price goes above rupees 100 and sell it if it drops below rupees 95. Generally speaking, algo trading tends to reduce the need to constantly monitor markets, drives down human intervention, and enables faster execution of trades. Moving on to the new framework, SEBI proposed the use of application programming interfaces or APIs provided by brokers for algo trading. Here, the broker would act as the principal, while the algo providers, comprising fintech firms or vendors, would form an agent. Tech savvy retail investors who develop algorithms must register them with stock exchanges provided the algorithms meet the specified order per second threshold. This threshold for categorization as an algo would be deliberated upon by the Brokers Industry Standards Forum under the aegis of the stock exchanges and in consultation with SEBI. The market regulator also prescribed that all orders conducted through the interface should be tagged with a unique identifier provided by the stock exchange. Further, while retail investors could use the algorithms for personal and family investments, they cannot offer them to other investors. Within the API framework, the rules mandate that brokers should deploy systems to identify and categorize orders above the specified threshold as algo orders. Besides these, brokers must block open APIs and ensure that access is only provided through a unique vendor client specific API key and the broker verified static IP, allowing traceability of algo providers and end users or investors. Moving forward, SEBI prescribed two types of algos. Firstly, execution or white box algos, where the logic would be disclosed and replicable. And secondly, black box algos, where the logic is concealed from the user and the system isn't replicable. For the latter, algo providers must register as a research analyst and maintain a detailed report documenting the functionality and impact of the algorithm. Notably, when the logic governing an algo changes, its provider must register the same as a fresh algo and follow the procedure mentioned previously. Speaking of algo providers, the rules prescribe certain procedures for their onboarding. Firstly, although such providers aren't classified as SEBI regulated entities, they must be impaneled by stock exchanges. Brokers must also fulfill due diligence during this process. Finally, algo providers and brokers may share subscription charges and brokerage fees only if they disclose all the associated costs to the clients transparently. The rules also outline the responsibilities of various stakeholders during the process of algo trading. Firstly, concerning brokers, the framework requires that they adhere to an already existing algo trade provisions and seek the stock exchange's approval before making any modifications to the approved algos. As mentioned previously, they must tag all algo orders with a unique identifier to establish an audit trail. Secondly, regarding stock exchanges, they must continue their supervisory functions over algo trading. These include establishing a standard operating procedure or SOPs for algo testing, surveilling algo orders, behavioral monitoring, and deploying a kill switch feature. To explain, a kill switch feature is an emergency function that automatically triggers a halt on a trading activity and is considered the last level of defense against an algorithm malfunction. Besides this, exchanges must specify the turnaround time or TAT for certain algorithms like execution algos on a fast track basis and other algos on a normal basis alongside performing other duties. According to the draft circular placed by SEBI on its website, the Brokers Industry Standards Forum, or the BISF, is tasked with formulating the implementation standards of these norms by April 1st, following which the provisions would go into effect from August 1st, 2025. The current framework comes in light of the surge in demand for algo trading by retail investors and the subsequent pop up of unregulated algo platforms promising unrealistic returns. This move follows SEBI's 2022 circular ordering a ban on the partnerships of brokers with unregulated algo platforms, considering that the latter could cause market losses for retail investors who might be unaware of the risks posed by poorly designed and manipulative algorithms. However, while algo trading has been considered a revolutionary change by leveraging technology, it poses certain risks as well. For instance, technical glitches may lead to order execution delays or software bugs, or algorithms may struggle to adapt to high market volatility, backfiring on unwanted trades, among other concerns. What remains to note is how SEBI's new norms seek to address these concerns and deploy a safer environment for algo trading for retail investors. Thank you for watching. For more tech policy updates, please subscribe to MediaNama.